Hi, I'm Mike Gassewitz. Welcome to another episode of InFocus. Today, we're going to do a first quarter investment overview, and I'm joined by Brian Durno, our Chief Investment Officer. Welcome, Brian.
Hi, Mike. Thanks for having me.
Folks, if you're listening to this and you're on a platform where you don't see graphics or video, we are actually this time stepping through some graphics. So I encourage you to, if you have a chance, to have a look at this or on a platform where you could actually see some of the information. If you can't, no worries. It's still going to be riveting information. So I'm very glad that you decided to join us. So Brian, why don't we dive into it? And folks, what we do on a quarterly basis, Brian and the team, is they pull together a lot of information and they share this information with our financial advisors, the folks that you deal with at your accounting firm. And as I watched this, I saw some good material there, and I thought it'd be great for you as clients to see this as well. So that's what we're doing today. So with that, I'm going to just share some of these graphics right now. Okay. So let's dive into it, Brian, and start with the income-producing side of our portfolios and what we observed in the first quarter, and maybe talking about yield curves and the shapes of those yield curves and what's changed.
Sure. Yeah, we'll step through some of the highlights here because there was quite a lot of things that happened in the first quarter in the bond market. But this will be a nice summary for folks to, if they don't follow it every day. So what you can see on the graph is basically a picture of the yield curve in Canada, which ultimately shows you let's say the period 30-day rates, 90-day rates, all the way out to 30 years on the scale. And so if you compare that to, let's say, the fall of last year compared to today, you can see that at the very short end of the curve, we would say that the curve is normalized and become a little bit more, a little bit more flat. Compared to relatively inverted last year. So that, let's say, the curve has gotten a little bit more normal. But the thing you can notice also, the first 30 days to 2 years is pretty flat at the short end. And the long end of the curve, like the 7, 10, 20, 30 year part of the curve, hasn't changed all that much from last October.
Yeah, and so to your point, we're seeing the curve, as you say, normalize. Typically, you'd think if I'm lending money for a longer period of time, I should get a higher interest rate. And now we're starting, again, it's starting to get normalized. So a good thing to be seeing to a certain extent. More sanity, I would say.
Yeah, it takes one of the unusual features of the bond market out of the equation.
So let's switch gears then and understand what the spreads are. Basically, the difference in yields comparing corporate debt versus government.
Yeah. So what we see here, like in terms of the corporate versus government, it is also let's say, more normal there that for a longer period of time, if you lend your money out to a corporation, you should demand a higher return because more bad things can happen to a company the longer you lend your money out. So it's not unusual to have that upward slope. In our strategy at this juncture, we're relatively short term, so we like to focus on the first five years of that yield curve. And you can see in the purple boxes, that's the yield that you can roughly expect to earn on let's say, a very high quality investment grade corporate bond. So in that sort of 3 to 3.5 range, 375 at the longest end of the curve. And we compare that to let's say, the safest government yield, which is the Government of Canada bond yield. And that's closer to 2.5 and still pretty flat, like we showed you in the last graph there. So you still earn a pretty reasonable spread, especially in let's say, the fourth and the fifth year for lending money to super high quality corporations in Canada. And I might point out, actually, it's not immediately obvious there. A lot of folks would say, well, buy me the 3.5 instead of the 2.5 because it's a bigger number, and that for sure is absolutely true on the face of it. But I might add that Government of Canada bonds do more than just provide the yield. They also provide a little bit of protection for, let's say, a calamity or bad market environments or recessions or the kinds of things that go bump in the night. That it's not always true, but it generally is a safe haven in events like that. So it's not completely reflected in the coupon rate there.
And generally speaking, because I know we have obviously we're a custom portfolio, a lot of custom portfolios, but generally speaking, yeah, most portfolios, what are we seeing in terms of the split between, on the income producing side, government versus corporate bonds?
Sure. Yeah, we've the yields, because there's, let's say, materially smaller on the government side, but at least I can say on the government side they are earning in most cases higher rates than inflation, and that's a critical piece of information when you're buying safe government bonds is the protection against inflation. But we would be, let's say, more attracted to the corporate bond market.
Right.
Yeah, much more attracted at this juncture to the corporate bond market. So that would be reflected in portfolios with a larger, let's say, a materially larger weight on the corporate bond side than the government side.
Exactly. And again, the thinking there is, as you said, we're in extremely conservative type, yeah, like Canadian financial institutions, for example, that kind of debt.
That's right, and because it's shorter term as a strategic choice that we've made, you have less, let's say, credit risk because the time frame with which something would have to happen that's really bad to these corporations is very short. So your visibility into seeing the probability that something terrible would happen is much easier to predict the next 2 or 3 or 4 years than it is, say, the next 30 that could be
Right.
wildly disrupted.
Very good point. Let's move on to, I like this next graphic because it kind of talks about these spreads, and especially in the context of the volatility that we've all recently experienced. Why don't you talk us through this one?
Sure. Yeah, this actually, it might not look like it on the face of the data that you're staring at, but can be a source of comfort for investors, and I'll explain why. The green piece of data you see going all the way back, this chart goes back to roughly 2005 or so, and it shows you other periods of, let's say, stress in the marketplace. And you can see that in the gray bars there in 2008 and also during COVID. And what you're seeing in the little green bar there is the volatility index, which is not a bad proxy for, let's say, equity market risk. And it gets priced in pretty quick with this certain instrument called the VIX. And what we overlaid on top of that, though, which is very interesting, is the spreads. So you remember we talked about the spread on corporate bonds are a little bit higher than government bonds. You earn a premium for taking that risk. So that premium is actually called a spread. And that's an important measure in the bond market to express risk that exists systematically in the whole system. That might be a simplification, but generally that's true.
Right.
And so what you can see, during periods of very, very difficult markets, the equity markets, when they spike with risk, the bond market spikes with risk too. And so the only thing I'll point out, which you can see clearly in the last two periods, but what's very interesting this last time around, which was almost, let's say, a policy-led calamity on the equity side, and calamity was only a small little correction there, minus 21, I think it hit peak to trough, and has since quickly recovered. But it didn't get expressed with that same speed and vigor in the bond market.
Right.
And the bond market tends to be a little less twitchy about reacting to short-term news. They tend to be a little bit more longer-term focused. That's not always true. But it's not a terrible signal to look at on the bond market and say, hey, did they get as worried as the equity market? In this particular case, you can see not so much on the bond market side.
Which is good from a diversification perspective. That's kind of what you want from the bond side of the portfolio when things are going, again, some uncertainty happening on the equity side or the volatility. We're saying we'd like to see that stability on the bond side.
Exactly.
All right, let's switch gears and move over to equities and start with valuations and comparing between the different geographies.
Sure. Yeah, this has been almost a continuing trend for probably a number of years now. The difference in valuations from, let's say, the U.S. market and some other global markets, and in this case, we're showing Canada and the EFI markets, which is basically Europe, Australasia, and the Far East. So a basket of international companies. And so what you can see, the green valuation is the U.S. valuation, of course, at the highest, say, levels compared to the other countries. And all we're trying to show on something like this is just to express the fact that things in the U.S. are more expensive than they are internationally. More expensive doesn't necessarily mean mispriced. So some of this let's say, higher valuation can be explained by higher growth rates, higher profitability, and actually very fundamental things. And so, but it gets kind of simplified. Most people say, well, the U.S. market is expensive. And I think there's a lot more to the story there in the U.S. But the most important thing when you're looking at this kind of information is to see that the Canadian market and the international markets, relative to their own history, are trading at valuation multiples that are much more attractive, much more reasonable, and let's say easier to find bargains, or at least worthy candidates for addition to portfolios. So I thought that was just a useful thing to see the disconnect between the three markets here.
Brian, I really like this slide. Breaks things down by sector. Yeah, why don't you step us through this, please?
Sure. Yeah, this might look super confusing when you first look at it, but I'll try to help you navigate it. You remember on the last slide, a lot of people, commentators or the press would talk about the U.S. markets trading at 20 times earnings, and that's historically high. And you saw the graphic that would be factually true. The only thing that I might point out is that thing called the U.S. market is actually made up of 11 unique sectors, who each have their own, let's say, performance drivers, things that make them, relatively different from each other. And so that's actually where you start sort of shopping around. You don't go into the whole grocery store, you go down a certain aisle. And so these 11 sectors can be displayed on this graph. And so why don't I just explain what you're looking at here. The red line right down the middle, the vertical line, is what the U.S. market trades at. So that's the 20 times multiple that we looked at, roughly just a touch over 20. That's what we looked at last time. Anything to my left of that line, anything to the left of that line, and those are the 11 sectors displayed for you, but anything to the left of that line is actually trading cheaper than the market. Now, there's always many, many different reasons why stocks trade cheaper than the market, but at least that tells you that there's quite a number of sectors, 6 or 7 of them, depending on the day, that are actually trading cheaper, and in some cases materially cheaper than the market. So that tells you, as bottom-up fundamental stock pickers, you can actually go find some bargains in some of these sectors. Even though the headline number seems like it's elevated, there's a lot of things under the hood going on. The other neat thing, actually, right where you've circled there, the bottom left part of that quadrant. So not only do we have the red line in the vertical axis that shows you where it trades relative to the market, the green line, which is the horizontal line, describes where those things normally trade against the market. So not only are they cheap, let's take the healthcare sector as an example. So not only is it materially cheaper than the market, it's actually significantly cheaper than where it normally trades against the market. So at everything
that's
here,
that 30-year average. That's the vertical axis is the 30-year average. Yeah, sorry.
Precisely. Yeah. So normally, what that information would tell you is that the healthcare sector normally trades at a bit of a premium to the market. So now you can tell right away that, first of all, it's cheaper than the market, and it's materially cheaper than its historical average against the market. A lot for our listeners to swallow, but very, very, very insightful information for us to glean about where we should look for new ideas.
And then basically just carrying through this basic Cartesian coordinate tutorial we're having, but this is so important, or interesting anyway, in terms of trying to digest a lot of information and data, is then those sectors that are in the, let me get this right, the upper right here. I'll try and circle it. And folks, I apologize for my sketchy, my poor graphics skills here, but what I've tried to circle here, talk to us about those. Those are the ones that are probably higher, right, from a valuation perspective.
Exactly. Higher absolute and higher relative. So not necessarily wrong, just higher.
Yeah. Right. So basically, what's the takeaway in all of this? What's the message we're trying to say?
Yeah, it's not unlike walking through the grocery store and noticing that down the healthcare aisle, you'll probably find a lot of things on sale. Not necessarily, but you have to walk down the aisle to have a look. And so when we're sort of trying to say, you're quite right about the avalanche of information. There is no shortage of information out in the marketplace. There's very few places to get insight. And looking at the data this way helps, let's say, present the idea that some of these sectors might have some very interesting things. And matter of fact, one of our more recent additions to our core pick list did come from the healthcare sector.
Right. And just carrying your analogy, just because it's on sale doesn't mean it's a good buy.
Precisely.
There could be a reason it's on sale, and so you really you always have to look under the hood. But yeah, no, I really like this as a good summary in terms of the sector-based approach and how we look at things. So why don't we look at profits? We got both the U.S. and Canada, and sort of the trends and what we're seeing.
Yeah, it's a good time to do that. We're probably about 3/4 of the way through the U.S. earnings season. Each week there's an avalanche of earnings that come out from the U.S. market. Canada's a little bit further behind, but there's been quite a number of companies produce their earnings in Canada as well. So we have a few, let's say, markers. And why this is so very important, like when people talk about markets generally, if they're going to make the claim about an average thing called a market, they really should focus themselves on the fact that there's a few very fundamental principles that create the health in market, create a healthy market. One of them we looked at before was valuations. Very important, let's say, stool on the leg, or leg of the stool that you'd want to pay attention to. The other one's corporate profits. That's another one. So corporate profits fundamentally are very, very important to the market. And so it's good to talk about that, I think. So with roughly, say, 3/4 of the companies having reported, well, I won't go through all of them in detail, thank goodness for the listeners. But I can say that the earnings season so far, and it's not done yet, there's still 1/4 of the companies left to go, so it could change quick here. But so far, it's been a relatively strong quarter. The number of companies that have been beating their estimates is just slightly higher than the average, but they've beaten their estimates by a larger percentage than the average, so a little bit stronger results. And I might point out that the growth rate so far this year is double digits, 11, 12, 12.5%, depending on the data you're using. But double-digit growth rates in corporate profits is one of the things that underpins the valuation support is strong fundamental performance. I think this would actually be the 7th quarter in a row of growth from the U.S. market.
Okay. And on the Canadian side of things?
Canadian side of things, basically getting not quite as much data coming from all the Canadian companies yet, but a similar story of so far so good. The 2025 estimate for this calendar year for the U.S. was around 9.5, 10 in that ballpark, and from Canada you're looking at around 11%. So I might remind you about the valuation difference between the two markets. The Canadian market trading at a much lower valuation, but showing similar growth rates in 2025. So that's just, in itself, doesn't mean anything, but it's just an interesting little piece of information. One thing, actually, if we're on this slide, sorry, I might just tell a little story about this. This is very interesting little tidbit on this slide that just kind of popped in my head as self-evident, but it's very interesting that if you look at 2015 there, and this is the earnings, of the TSX, so pretty much the whole, 226, whatever it is, companies on the TSX. $786 is how much they earned in 2015. And you can see that the trajectory of corporate profits is not linear. There's occasional bumps in the road, and anyone that's run a business would know that there's very few of them that go straight up every year, sadly. So you can see that the trajectory is not perfectly linear. You can see that there's some unpredictability year by year on what happens. Right. But if you focused out from 2015 to 2024, 25, roughly 10 years later, you can see that earnings doubled, roughly.
Yep.
And so that's kind of one of those things that I think at this kind of a market environment we're in is a great reminder about signal versus noise. And for long-term investors, it's actually the signal that you're most trying to pay attention to, but I would say it's almost the hardest thing to find because the market is flooded with so much darn noise. And you can just imagine, when you, from 786 to 747, you see that earnings from 2015 to 2016, you can just imagine the narrative back then. It would obsess you and worry you that might be a permanent feature of markets, that earnings are declining. But when we stay focused on that longer term, would it surprise you to find out that back in 2015, the Canadian market traded around 12,000, and that 10 years later, the market's trading around 24,000, which is pretty much in line with earnings. Yeah.
Just about took your your punchline there. So sorry. Headline. Exactly. So it's coming back. I love the way you said that. Noise versus signal, short-term traders versus investors over the long term, and looking at these trends. And again, back to sanity, if you will, sanity prevailing, a nice doubling. And as you said, that's exactly what we saw with the TSX. So excellent. Thanks, Brian.
That's it. Thanks.
Yeah, let's move on. So this is the next section. Obviously, we've all been dealing with again the volatility. We've had some good discussions. Hopefully, you as clients have That's given you hopefully some reassurance in terms of what we do here at TriCert and the QSect approach. And you had some great graphics that I thought would be great for the clients to observe. And so let's look at volatility. And this one in particular I really liked in terms of just comparing peaks to call it trough decline. So yeah, talk us through this one.
Sure. Yeah, this is a great time to just remember as equity investors how hard it can be sometimes. And I would argue almost every single year it's hard at some point in time for equity investors to have their resolve, because the market tends to have declines every single year. And that's what this graph is showing you, is the S&P 500 as a proxy for markets all the way back to 1980. It shows you the calendar year return in blue. So those blue bars that you're looking at is the actual full year, January to December. How much did the S&P go up or down by? And you can see the first thing to notice is mostly up. So that's obviously why most people are attracted to equity investment in the first place. And once again, not linear, but mostly up. So that's good news. The very interesting thing when you look at those yellow dots is during those same years, let's even take 1980, a pretty strong year, but almost a minus 20% drawdown during that year. That's what the yellow dots are showing you, is the worst period during that calendar year that an investor would have experienced. And they're all over the map, but there's never very few. I don't think there's a single one where you didn't get out without some declines in a calendar year. And sadly, that's just another one of those reminders for investors that, well, that is the price we pay in the short term for long-term performance, is volatility.
So just want to play back what we're staring at, just to make sure everybody gets it. The blue bars, that's the total year investment return over the year. The yellow dot is peak to trough, what, as like any signal in terms of what's going on. In this case, it's the market. Peak to trough, you see some pretty significant drops, even though you'll see a positive blue bar corresponding to that yellow dot.
Precisely.
Yeah.
Actually, the last, it's very unusual. I've been doing this for a long, long time. And the last handful of years, we've had, if you see those yellow dots, 2018, 2020, 2022, and now again in 2025. That's 4 periods in the more recent history that have had minus 20% during the calendar year at some point in time. Right. So yeah, just never fun to go through, but the long-term signal still well intact.
So back to the headline against this graphic is stay in the market. Sanity will prevail. Obviously you have to observe and look for opportunities, but at the end of the day, stay in the market.
I'd say stay in the market if you have a sound investment process and philosophy informing your decisions. Yes.
Excellent point. Excellent caveat there. This very noisy graphic. Why don't you talk us through this?
Yeah, this is another, sometimes history is your friend and sometimes it doesn't help you at all. But this one's a very useful one. When lots of clients expect investment managers to have, let's say, a crystal ball about the short term and what's going to happen next and those kinds of things. And I can say it's very tricky to have clarity on the short term. There's no shortage of supply of people who will tell you what they think will happen in the next 6 months. There's no shortage of that at all. But I thought this would be a great little, let's say, historical lesson on how tricky that can be. So what you're looking at here are 14 different paths from the last, well, basically since World War II. So a long time frame. You've had 14 different times that the market has drawn down or declined by 20% peak to trough, which we saw on the prior slide. It's not that uncommon.
Right. The yellow dot, basically taking the last graphic to this graphic, the yellow dot drawdown, and and then the lines we're staring at here are what happened after that. Sorry, keep going.
Yeah, that's precisely right. And the first thing you'll notice, when you look carefully at the graph is that it's very unpredictable what will happen after a minus 20% decline. You can see plenty of periods that turned out very, very strong, very favorably. You've got looks like it's 1998. And
1998, yes.
Yeah, in 2018, we're up there at the top at plus 40.
Right.
But you also have 1973, which many investors probably won't remember 1973, but minus 35.
Right.
So, and I think what is really interesting when you just look at that whole spray These are your base rates of potential outcomes after a minus 20. And
Right.
if someone said, you have a 50-50 chance that it'll be minus 35 or plus 40, that's a big range of outcomes.
Exactly.
So
And I think back,
focusing,
oh, sorry, go ahead.
yeah, just sort of focusing on that short-term prediction is tricky.
Exactly. And I think, back to our process, you won't hear us often trying to predict what's going to happen. It's more being prepared back through quality investments, leveraging opportunities when we see them, but attempting to predict. That's what for me, this graphic just tells you, and that it's a mug's game. Honestly, we're not going to attempt to predict what's going to happen over the next couple of quarters. Just too difficult. Okay, let's shift gears then in the aspect of, okay, great, we've seen some volatility. We're driving home the message: stay in the market. Don't try and predict what's going to happen. At least for sure not in the short to medium term, and over the long term have quality holdings to do that. This was a great graphic, and I know you and the team put a lot of work into this in terms of just, again, understanding, trying to explain to the advisors and now to our clients that our the QSect approach, why we've been using it so successfully for 25 years. And so talk us through this, and what are we staring at here?
Yeah, yeah. So this is let's say some quantitative data or attributes of the kinds of companies or the kinds of things that we would seek out when we're trying to find a new company to invest in, or that reflects the companies we already own. I might just point out on the qualitative side something that won't show up on the chart, but the things that we sort of are interested in qualitatively. So not data driven, but this would be the kind of things. So I might just mention a couple of those, but mostly we're very attracted to resilient businesses. And when you look at companies whose revenues survive world wars and recessions, oftentimes their revenue line is very diversified, which tends to end up with larger companies.
Right.
So it's not like you necessarily say, well, we like large cap companies first. It's more like we like very resilient business models that have been battle tested, and that just happens to be we're able to find those in large cap companies. Market share leadership, very, very important. It's not easy to dominate a market, especially for a long period of time. So that's something that's clearly very important. So I thought maybe just share a couple of those.
Yeah, no, very good
Uh,
point.
and we'll get back to this chart. So yeah, this is the graph that we're looking at that would, let's say, characterize some of the more quantitative attributes that we would say, well, we have to measure companies on many, many different metrics. These are just a handful. But I thought it would be very useful for clients and for people to know that there's a good reason why you would search for these kinds of attributes in a company when you're looking for an investment. So what you see on this graph here is the compounded annual return of an investment strategy that uses these attributes as the reason why you bought them. And it goes from 1990 to 2024. So it's quite a long period of time, a few recessions in there and some terrible market environments, many of which I invested through and got a few extra new gray hairs because of. And so if I just explain the very first one, ROE, return on equity, a common financial fundamental attribute. If you just bought the 25 highest ROE stocks in the US as a strategy, and we're not proposing anyone does this or thinks that it's that simple, but it's just meant to show you the importance of some of these attributes and why they're so critical for a component of the fundamental analysis that we would do. But return on equity, that very first bar, if you just use a strategy that just did that simple thing and ran that over from 1990 to 2024, it shows a return of just over 14% per year. And that compares to the green market return. And you can see that was actually a pretty good strategy to use. So it tells you that ROE might be one of those signals that's very important. Those first two signals, I won't go through each of them in detail, but those first two are basically a proxy for profitability and value creation. It turns out that if you have profitable value creating businesses, a symptom of that value is dividends and share buybacks and acquisitions and projects that they can invest in for growth. But those next three are things that high value creating businesses can do with the capital that they've created from their value creation exercise. And so those next three attributes, it turns out a lot of people just keep it simple and just say, well, I'll buy companies that have good dividend growth. They're skipping the step that it was a value creating company that may have done that. And there's nothing wrong with that. But you can see that those independent variables of dividend yield, dividend growth, and share buybacks were also strong value creating ideas to populate a portfolio with. Then the next two ones are valuation. And it turns out, of course, which we've all learned, paying a cheap price will lead to better results. And the last two is basically just call it a proxy for the strength of the balance sheet. And I think it goes without saying, knowing that bad balance sheets can get you in deep trouble in the equity markets. So the bottom line is that the kind of attributes, and there's a lot more than just this that we look at our shop, but these are examples of the kinds of attributes we'd be very attracted to. And you can see there's darn good reason for it. Each of them independently are good strategies that have the potential to lead to better performance.
I really like this because, as you said, it almost like filters on a investment strategy perspective, each one. We don't follow any one of these. We combine these with some of the qualitative attributes you talked about, bring those things together. But if you're looking at things from a pure quant perspective compared to the market, it's great to kind of see this analysis. It's over a long term. Again, back to we're long-term investors. It just reinforces the approach, and hopefully gives comfort. It gives comfort to us in terms of our approach, that it's grounded in, again, parking the emotion and focusing on the fundamentals. Yeah, good stuff. That leads to this other one. We talked about, you were talking this graphic here in terms of dividends. So talk us through this one.
Yeah, this is one of those pieces of information. Now, this chart has some data that might be maybe a year or two old or so. But actually, I've seen many of these studies replicated in many different markets that basically say the same story. So I'm not necessarily pinning my hopes and dreams on this specific data point, but the theme and what it tells you is been consistent my whole career. And what you're seeing on the bottom scale on the horizontal axis is let's say standard deviation. They use that as a proxy for risk. I would have some arguments about whether or not that's the perfect measure of risk in a stock. But either way, we'll use that for this study. That's how much a company wiggles around and how, let's say, risky it is compared to the axis where it shows you the total return there on the vertical axis. So the first thing to notice, the investable universe right there in the middle, that would be, let's say, all the stocks in the market. And so all you're really trying to do with this graph is show that if you seek value creating companies that use that value creation to pay dividends, grow their dividend, or buy back their shares, all of those strategies move up and to the left, which means a higher return with lower risk. So why most investors would ignore that simple fact is hard to understand, but lots of people would think it's probably too simple. And so that's just one of those examples that dividend paying companies, share buybacks, those kinds of things are important markers for probably a pretty darn good business.
Yeah, so sorry, I'm trying to catch up in terms of the graphics. So again, apologies for our listeners and watchers. But yeah, as you say, up and to the left, what I've circled here, again, lower risk. Not only is it lower risk, they actually have higher annualized returns compared to yeah. Why don't you talk us through what I'm circling now here in terms of the lower right-hand side of the grid?
Yeah, so the companies that don't pay dividends or never have would be that non-dividend payers as an example. So those as a class. So it doesn't mean that there's not exceptions and companies that have done wildly crazy well, but as a class, as a base rate, the non-dividend payers would have higher risk and lower return. And so you can see that with the other examples of the kind of company. Just makes it a little bit harder to find great companies with those characteristics.
So good graphic here in terms of, again, reinforcing our approach. One of the things we do look for, dividend payers who have consistently demonstrated their ability to increase those dividends over the long term. Nice. Okay. This is the last graphic, and I also found it a very powerful one. So talk us through these numbers.
Sure. Yeah, this is not, is we're maybe a little sensitive in Ottawa about using the word back of the hockey card. I probably should have changed that to baseball. Um,
There's
but
probably a
this
lot of
would
Leafs fans listening, but that's okay.
this would just be a simple average of our, let's say, our core pick list of ideas that our portfolio managers populate portfolios with, and they do share these common sort of consistent values that we just talked about. And so I thought it would be useful just to see what that average looks like. The core picks average ROE right around that 25% mark, and then I compare that to a blended average of Canada and the US as the two marketplaces. So on average, more profitable than the average company. On the dividend yield side, a little bit higher yield than the market. The dividend growth rate over the last 5 years, once again, a little bit higher than the market averages. And all of those, let's say, wonderful fundamental attributes, we're able to find them at a cheaper price than the average.
Pretty powerful. These are our core picks. This is back to the QSect approach and the equities that form that list. And again, it's a good analogy compared to the averages of the markets, the U.S. and Canada. You kind of see the approach in terms of what we're looking for, and so again, we're not looking for cheap. We're looking for good price, really high quality companies at good prices. So back to the last element that I attempted to draw a square around in terms of the prices that we're paying. But a good summary of, again, back to the QSect approach, combining that in the context of volatility, hopefully gives some people some comfort as we go through. Again, it's more than volatility, really, uncertainty caused by things like Liberation Day, and it's good to understand the approach, and hopefully people get some comfort as to how we're going to get through this together. So Brian, thanks again for this. Appreciate all the good work that you and the team do. As I continually say, it gives me comfort as the leader of the organization, but in terms of what you, our portfolio managers, the whole team, and then obviously what our advisors do at the CPA firms, our accounting firms, especially through these times of uncertainty. And so, folks, I always offer that to you. Don't hesitate. Anything in here that was confusing, probably was, don't hesitate to reach out. Feel free to reach out to myself, talk to your financial advisor at your accounting firm, or when you're talking with your portfolio manager from TriCert Investment Counsel, don't hesitate to have a good conversation with them. Take care, everyone.